Hi guys, thanks for tuning in to another episode of Nuggets News. We're back with our monthly Australian economy and housing update. It's been a massive month with the budget, everything that was already going on, the US election, so lots to get through. And you know it's a big month when Martin has 18 slides for our 10 slide show. So welcome back, Martin, and how have you been?
Yeah, it's been crazy, crazy. We are in weird times, and I did try to boil back the slides, but look, there's just so much to talk about. And the point is that it's all very much interconnected, right? So as soon as you start pulling at one thread, basically you've got to go and talk about other things to be able to complete the picture. So that's why we've got a few to get through today.
Absolutely. And people think that, the crypto world and gold and markets and housing and banks, and it is just so interconnected these days. And I'm not sure if you've seen that the stablecoin world has grown from $1 billion to $20 billion. And I think this time next year, it'll be at $100 billion. And we'll be chatting about how that is affecting actual central bank policy. But we won't go off on that tangent.
Not in today's, but we might cover that next Tuesday when you and I are on my show talking about all such things. Because you're right, there is a huge inflection happening at the moment. Right, we're at the very early stage of it, but the old world is passing.
Absolutely, and I'd honestly forgotten about that. So that is a good reminder for. I'm going to be doing a bit of an AMA, a bit of a crypto episode on Martin to return the favour next Tuesday night, isn't it? So cool.
Yep, and in fact, the last slide is actually an advert for it, so you'll be able to talk about it then as well.
Fantastic. Any, I guess, general overviews from what's happened in the past month? From me, just quickly, the budget was, I guess, there was definitely some positives, cutting tax for a lot of people. I think it's still too little too late in a lot of ways, particularly from what the RBA did this month behind the eight ball. Global central banks, we're starting to see this whole fiscal, you've got to do more, and the blame game, which we've been speaking about for ages. And then that podcast that Joe did, our friend from the Jolly Swagman podcast with Ian McFarlane, he was really honest. Former head RBA governor talking about how monetary policy maybe hasn't even been that effective over the years. It's these bigger demographics that the Harry Dents of the world talk about. And you can use it at those turning points, put interest rates to 17%. It's going to change people's behaviour. But this game where central bankers have a meeting every month and RBA is talking about cutting 15 basis points, it's just doesn't make any difference.
Mhm. Well, you know the old story about the emperor has no clothes, right? I think we're seeing that in spades now. You look at what the central banks are trying to do, you look at what the economy is doing, and as we've said before, the virus has really shone a very deep spotlight on stuff that was already wrong, right? And so I'm a bit frustrated by the fact that the budget is being framed as a response to the virus. No, 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 no. There were things going wrong previously, right, in terms of the economic parameters. And, we'll talk about the budget in more detail. But the problem is we've got a set of doctrines driving policy, which is really not actually appropriate for the times, nor indeed laying the foundation for the future. And I'm so concerned about the tactical nature of what's going on vis-a-vis the real strategic things that we should be thinking about.
And I mean, that's Steve Keen says you've got a map of Venus, but you're on Mars. And I joke about that sausage machine where they keep putting in these things and wondering why there's not sausages coming out. But it's really, like you say, their models and their education and the real world. The real world's changed dramatically in the past 10 years, and it's just not working, everything that they know.
Yeah, well, one very senior person who left the Reserve Bank quite recently has basically said the Reserve Bank itself is myopic. It doesn't actually allow itself to be challenged. It's sort of wedged into this particular way of thinking and then basically indoctrinates everybody else. I mean, that is as a clear articulation as I've seen as the fundamental problem we have.
Yeah, I know Dr. Peter Tulip, Steve Keen likes to joke about his name as well, but he's right. And when you say that, it almost sounds like a North Korea. Like you're not allowed to think differently. You've got to fall into this line, and not good. Not good.
No.
Okay.
No, but we'll get into some of that as we go through, because this is now a fundamental point between tactical, things and more strategic things that we should be talking about and thinking about, and we'll touch on those as we go through the slides.
Yes, you've got your stuntman John Adams on the slide one day, mate.
I mean, that's how I feel at the moment. I'm hanging on by my fingernails, right? And when I talk to a lot of households in my surveys, that's how they feel too. So I thought it was quite a good illustration of how things are.
Okay, so the first official slide here, we've got credit demand, not the supply. And this is something I raised many months ago when I was speaking to my friend who's a hedge fund manager in Sydney. And he was saying their investments and their exposure to Australia is at record lows. And the thing that is worrying them, it's not so much even the availability of credit, but it's the demand. And people just weren't interested in starting a small business or getting that car or doing a extension to their house. So it's all well and good to say, hey, we're scrapping responsible lending laws and stuff like that. But at the end of the day, people still need to want to go into more debt.
Well, and the thing about this particular quote is it comes from the Council of Financial Regulators itself, right? So this is Treasury, Reserve Bank, APRA, ASIC, and a few other hangers on, right? So effectively the think tank, and they're basically calling out that demand's the problem, right? So you might have thought that if that was the case, then there would have been demand side initiatives in the budget, right? And demand side initiatives from the Reserve Bank. Whereas, of course, we don't have that. What we have is more supply side stuff, as we'll talk about, right? The fundamental issue is you can create the conditions to borrow by taking rates really low, and you can throw liquidity into the banking system, and you can reduce lending standards. But if businesses and households are unwilling or unable to borrow more, then the whole scheme just falls apart. And remember that what we've had over the last 20 to 30 years is an economy that's driven by ever increasing debt. Our household debt to income ratios are some of the highest in the world. That's allowed, of course, the old house price growth, bigger mortgages, machine to work. So this machine has been stoked by debt, right? Demand driven. And now effectively demand is just evaporating. And that is the fundamental strategic issue that we face in Australia and in other countries too, but specifically in Australia. You can take a horse to water, but if they don't want to drink, they don't drink.
And it's almost like pushing on the string, as you say, Martin. So it's those demand side things that you want to see. And an example of that would be, let's have no taxes for startups. And if you don't want to do it for everyone, let's just say, okay, in the technology space, we want to encourage entrepreneurs to come here and there's going to be no tax for the first 2 years. They get special loans and things like that. Whereas at the moment, there's none of that, but there's things like, oh, hey, housing's unaffordable, so let's make it that they only have to have 5% down, or let's increase that first home owner, and then the builders put up their costs another 10 or 15 grand, and guess who gets that money? It's the person that's selling the house that has all the properties. Any other examples of things that you'd like to see?
Well, the point, one of the things is tax cuts, right? Well, tax cuts are all very well if in fact people are earning, right? And of course, the more you earn, the bigger the tax cuts. But if you're not earning, it's irrelevant. Or another one is business write-offs. So, businesses can invest and basically take 100% write-off. But actually, if they don't have the revenue coming in to be able to actually manage their cash flow, to be able to buy new stuff, they're not going to buy new machinery. They'll basically use the old machinery they've got as hard as they can. So those are two examples where effectively, whatever you think, it's not increasing demand, right? And if we don't get demand up, then the whole thing just falls apart.
Exactly. All right. So flogging a dead horse, we've got this broad money, and the stat that's been flowing around lately from the US is that their M2 money supply is up 22% this year, and that's without maybe this extra package coming, which could put it up towards 30-35%. So these are enormous increases in the amount of money that's in the economy.
Yeah, so the fascinating thing about this is that the money supply has grown by 11.5% over the last year. That's the RBA number, right? So there's a lot of liquidity in, and that's, of course, to do with the government support, JobKeeper, JobSeeker. It's to do with the superannuation withdrawals and everything else. And yet, credit is going down, right? Now, in a debt-driven economy, the only way to actually increase growth and momentum is to grow credit, right? So what this tells me is that we've got to the point now where increasing money supply, throwing more cheap loans into the banking system, is not having an impact, is actually having a negative impact. And we're getting to the point now where with low interest rates, in fact, it's more likely that credit will decline further rather than rise further, despite all the initiatives like, for example, removing the lending standards and all of those things. So we've got this catch-22 situation. Now, here's another thing. Many people will define inflation in terms of the increase in the money supply. So, at one level, you could say, well, inflation in Australia is 11.5%, right? But the question is, where does that money go? If it's not going anywhere productive, if it's actually ultimately going down to pay debt down, which it is, we're seeing a lot of that. If it's basically people holding on to it because the savings ratio is up, knowing that later they're going to actually get into financial difficulty, all of those things are actually draining activity and draining momentum in the economy rather than actually driving it forward. So we're in the situation now where all of these stimulus measures that are being thrown into the system are actually not having an impact or the impact that everybody wants. And this is a really critical chart to understand, because my view is we are indeed flogging a dead horse.
And that's also important in the QE and the money printing that we hear about. A lot of that is going to reserves in the banks, and it sits there as reserves. So you can print $3 trillion and sit there and say, why aren't we getting inflation in the real economy? But if that's sitting there in the bank's coffers as reserves, and then they've gone down this path of not being willing to lend to startups that far rather write more mortgages in Australia or in the US, they're not allowed to speculate with that new money that's sitting there as reserves. But you're robbing Peter to pay Paul. That dollar that would have otherwise had to be a reserve dollar can now go speculate on junk bonds because they know the Fed's going to buy junk bonds. So this is why you're seeing those asset prices go up 11% a year, but you're not seeing 11% inflation.
Correct. And the point there is, as interest rates are squeezed, and of course banks can now get very, very cheap funding from the Reserve Bank. It's 0.1%, I think, is the net real number. What that means is that they can actually raise funds more cheaply than they could in the bond market. So they're actually not doing so much bond issuance and actually repaying bonds, right? But what they're sitting on this really, really narrow margin. Now they can take mortgage rates down so far, but as they do that, their overall profitability gets compressed. And in fact, with low interest rates, you end up with banks lending less, not lending more. And so this whole fallacy is that you cut rates and you stoke the credit. No, you don't necessarily, right? Demand isn't there and profitability isn't there. So you end up with probably less lending rather than more lending. This is a fundamental important point.
Yeah, absolutely. So has near zero rates done any good? We've seen Philip Lowe be very vocal for the past few months, and even I think last year he was saying things like negative interest rates haven't really shown to do that much good in Europe and it harms the banks. And then I think it was 6 months ago when we had some countries saying, hey, negative interest rates are on the table, while others were saying these do no good. And it's kind of like, well, hold on, you guys have all done the same degree. It should be very easy to say which one it is, and you've got opposite views. So how can this be?
Well, look, the fact of the matter is, and I'm quoting here the Financial Review article that covered the podcast that you mentioned from Joseph Noel Walker, or the Jolly Swag Man. He actually came on my channel the other day, and we talked about some of these things then as well. But basically, RBA chair has basically said the Reserve Bank doesn't know what it's doing. I mean, pretty much, right? It's saying it's been slow to the party, and comparing what's happening here with around the world, it's not looking particularly good. But also, the bank has reacted very slowly, and the question is, are cutting rates to zero or thereabouts actually having any real positive impact? Right? Goes back to my earlier point. You can cut rates really low, doesn't necessarily translate to increased demand or more credit. And we've got to the point now with this whole debt-based monetary system that we've had for the last 20 to 30 years is coming to the end of its useful life, I think. And, you've got to ask the question, is the structure in terms of Reserve Bank and APRA fit for purpose now? Do we need a completely different way of thinking about central bank strategy and policy? Because you could argue that the Reserve Bank has been appalling at trying to forecast what's going on. They've been slow to the party. They probably should have cut rates earlier, but they didn't, and then they sort of left it too late, and they've hardly done the right thing. Now, there is an argument for saying, well, you might want to take rates deeply negative and try and actually get some momentum back in the economy. But I go back to my other point. If demand is not addressed first, it's not going to work. So I think we're actually at the limits now of monetary policy, right? And I think we're seeing the same risks here as in the US, where effectively this whole edifice is now being called out as potentially not fit for purpose. And that's a big deal.
Yeah, and we've seen rates decrease over time. And over the past few decades, we've lived through this period of just unmatched prosperity and innovation. And we had the demographics, the baby boomers come through, everyone's buying these stocks, putting them in their super. And now that's starting to unwind. And as I was saying before, it's all good to tinker at the edges, and you can lower interest rates here and there, but it's really the demographics and the economy that is the 99% that dictates what's happening. And central banks are beginning to realize that what they were doing at the edge was the 1%, and it didn't really steer things that well. And now they come into this realization, as you say, Martin, that hold on, not only are our tools exhausted, we're at zero, and we've been printing all this money, but what we were doing anyway, even if we had, say, 5%, maybe it would help a little bit, but it's not going to be enough to stimulate the economy and change these far larger natural forces. And you can't play God. That's always been one of my messages. There's finite resources. The real economy is so much more complex than your models. And that sausage machine analogy that I always talk about, they've got all the ingredients in the world. They can say to the government, hey, you can spend as much as you like. They can give the banks all these reserves. The central banks can say, we're happy to just print and monetize whatever you do, or give people direct money, which is probably where we're going next. But at the end of the day, if that sausage machine or the economy, or however you want to think about it, if that's all broken and the incentives are wrong, where the money flows to the wealthy, as over taxation of the small guy and everything that is creating inequality, nothing is going to get better unless you fix all those fundamental things, which is what we're talking about.
Absolutely. And, you can go back to fundamental principles, right? Originally, money was linked to gold. So effectively, there was a small amount of growth because you could actually mine a little more gold, but it was always anchored, right? So there was fundamental value there. Then we moved to this sort of fiat system where effectively you can open the taps and create more and then turn it off. And so you saw these very big areas of growth, and then a bang, and it would collapse and it would grow. And so you see up, down, up, down. But actually, if you look at it over the long term, you could argue that actually has not been successful. So effectively, we've ended up now with this sort of big hole that we've got here. So you've got to come back to some fundamental questions, which is, how do you anchor the currency, right? Any currency, whether it's the dollar or whatever, right? And, is it gold? Is it crypto? I don't know. But the fundamental point I'm coming to is that the way that the system is working at the moment is not fit for purpose. And unfortunately, those in charge, they just keep repeating the same thing again and again and again. And, the old adage about, define madness, you do the same again and expect a different outcome. Well, guess what? You just throw more money out. You have to throw ever more money at it, increase liquidity. It's a logarithmic increase rather than a linear increase. It gets to the point where you think, well, hang on a moment. This whole dance has got to stop. We need to find a different way forward.
Yeah, and I might share some more thoughts at the end while we keep going at the moment. But the $1 trillion debt, that is, again, it's kind of like that point where you go to zero or negative interest rates, and the average guy on the street says, well hold on. Not only am I not getting interest now, but I'm getting penalized. And I think when people see $1 trillion, I think they mentioned it on, the project the other night and on the news. And every day people that don't care about economics hear this thing that Australia's going to be in $1 trillion debt. It's very different to just all of a sudden reaching that point. Do you know what I mean?
Well, yeah, I mean, the budget was all about massive spending, right? But the question is, where is the quantum? Is it right? Is it not? I think some spending was absolutely required because of what's happened. But the point I would argue is it's not being placed in the right areas. Goes back to my demand supply question, right? So essentially, you could throw money into the system to try and encourage businesses to invest. But if the businesses are not confident about the future of their business, they won't invest. Same with households. Households won't buy property or other assets in a situation where their own income is under threat or their jobs are under threat. So in a way, I think what we've done is replicated the mistakes of the past decade here. So, a few interesting observations. The underlying cash balance is going to go very negative, and then they say it's going to come back. The debt to GDP will go up to about 44%, I think, which, by the way, on a national basis would still be quite low, but for Australia is extremely high. The GDP projection, which of course dropped significantly negative, is going to bounce But that is a sort of mathematical bounce more than anything else. It doesn't necessarily prove a lot. And then it's going to come back to a sort of a mid path. Again, they're just sort of assuming that we're going to go back to where we were before the virus, right? Not understanding that the world has changed and the virus was not the cause of this problem. The structural issues in the economies around the world were the problem. And then the other interesting point is, of course, net migration. If you look at that, the fact is that for the next couple of years, we're going to see a net outfall of people rather than an inflow of people into Australia, which fundamentally changes the story about Australian economy, because the Australian economy basically has been driven by population growth, bringing more people into the country to increase GDP, more debt and more lending. That's why house prices have gone up so high. So those levers are now essentially not working. And it's interesting because most of the commentary amongst most of the journos was pretty positive about this budget, right? And basically says, well, we have to do something, right? But actually, Citi, which I'm just quoting here, is probably one of the better ones, because 2 points, right? The first is, the significant point to make is the amount of stimulus that the government is planning to put into the economy ahead relative to what they did is lower, significantly lower, right? And whilst there will be some winners and losers, the retail sector might well, and infrastructure might well work quite well off the back of this and get some benefit. My worry is that this ability, for example, to be able to fund new trainees, apprentices, well, unless you control it really carefully, what they'll do is they'll allow senior people and then hire some new junior people, right? Which, and you get the government money. And that money, again, is going back to the firms, just like JobKeeper did, right? And it's down to what the firms do. So this whole thing is predicated on a set of false assumptions, in my view. And I worry that we're going to be spending this $1 trillion, right, which we've got to pay off over, 20, 30 years? And I know that rates are low and that's helpful. But this is a big number, right? And in fact, if you run the projections forward in terms of future expenditure, it's probably going to be 1.4, 1.5 trillion before we finish. This is naive and, I think, myopic in terms of the way this has been constructed. And frankly, it's just going back to the last 10 years and trying to replay it again rather than taking a different direction for the future.
Yeah, this immigration one that we spoke about a lot in previous episodes and in our documentary, this is 200, 300,000 people that are coming to Australia every year. And it gives that false sense of growth. And if we look at that real number, we can say that the economy has been very sluggish and almost contracting once you take out this figure and account for that. And now it's actually going negative in this year and next. I think that is going to have a huge dent on things with the current situation we find ourselves in. As you say, though, debt to GDP, 44%, other countries over 100%. That's when Steve Keen and others historically talk about that model where debt to GDP gets around 130%. I think it's 96% of times countries will go into a recession or depression once you hit that number. So our government debt is relatively low, but I spoke about this in a video the other night. It's almost like we've got a different problem where others are scared of going to too much debt. We're focused on getting a surplus. So for us, it's kind of the same thing. We're scared of spending more because we're close to that zero number. So it's kind of the same problem that we end up getting to. But when they start to pick winners and losers and saying to doctors and lawyers that you're going to be paying more to do that at uni, and saying to those young guys at Subway and Macca's, and there's this game theory where people are going to hire a new junior every month to keep getting this, like the baby bonus. So we'll wait and see how this all plays out. But I just always wonder about, do they sit there and think about these things from start to finish about where the money's actually going to flow and who's it going to actually benefit?
Well, the point is they've got a particular mental model of the way the economy works, right? And it's the same one that's shared by the Reserve Bank and by APRA as well as Treasury. It goes back to the Council on Financial Regulators, right? So they're basically assuming that this is a relatively coin-operated environment, right? So if you give a bit of money to businesses, then they'll be magically able to turn their business around and then start investing, and it'll be a business-led recovery. That's what their philosophy is built on. I just don't think it's it's feasible to see that happening. My surveys still say that 1/3 of small businesses are basically against the wall now, and it's unlikely that they're going to start hiring anytime soon. So there is a really this was a big opportunity to lay the foundation for a much better future, a different shape of an economy in the future. And no, this is back to the future. This is back, the last 10 years being played out again, but with lower interest rates. That's why I think interest rates will go significantly negative ahead. They'll try and drive that further. But it will just be more of the same. It won't actually get us to where we need to get to. And so this was a massive missed opportunity. And I have to say that I came away from the Tuesday speeches after, around the budget thinking, this is so frustrating, because you could see what the opportunity might be, and yet nobody wanted to step out and take it, because this is tactical, this is short term, this is get to the next election, this is just keep the old momentum rather than actually breaking out and thinking differently about what we should be doing.
Yeah, and the superannuation withdrawals, this is something we've spoken about a lot already. So anything else to add to this, Martin, other than what we've said plenty of times?
Only to say that it's running out of smoke, right? So of all the stimulus packages over the last few months, 19 billion net was actually from superannuation. That's disappearing, right? And that's my point. So all of this stuff that they're talking about investing in the future is actually less than the stimulus we had previously. So this is not a net positive. This is actually a net negative to total stimulus, right, ahead in the budget horizon. So in other words, the government's stepping back now, and I would argue it's too soon.
Yeah, and I just worry about these people that have taken all their retirement out. But we have covered that in detail. So the change in the Roy Morgan statistics and the official ABS statistics still drifting lower here?
Well, just so that's drifting low, but it's still massively high, right? 22.3% underemployment and unemployment. That's the Roy Morgan number. That means that 1/5 of the workforce is actually either not working or not working with the hours they want. That's a huge problem, a huge overhang. And the official numbers are being flattered by JobKeeper and all sorts of things. So I think that the Roy Morgan one is a better indicator. And I'm just very concerned that we are not understanding the real consequences of higher levels of unemployment, structural unemployment. And now I'm seeing more people on, big jobs, well-paid jobs, losing their jobs, people in their 50s, people in 55 plus, who will probably not get back into the workforce. This is a huge structural overhang, which again, I don't think that the budget tackled.
No, it is so hard to get people back into work in this magnitude of numbers. And every time the RBA drag their heels another month or whatever, it's just those figures going up and up, and it's tens of thousands of people, and it's just a data point, a 0.1% to those people, but it's real people's lives, and this is where we get into things like confidence going down.
Yeah, and that's the next slide. So, consumer confidence is up just a little, but it's still well down from where it was. And again, my surveys show me that people are concerned about what's going on. They're a lot more likely to save rather than spend. The idea of transacting for property, there are still some who will do it, but that's come off the agenda for many people now. And it's now become a survival question, right? How much do I save? Where do I put my money? Because I'm not confident about the next 12 to 18 months. So I think that structurally we have a confidence question. It goes back to why no demand. It's because confidence is bad. True for consumers, equally true on the next slide for businesses as well. So the business confidence data was down again, a little bit bouncy possibly, but essentially it's still significantly down across many different industries. And I'm seeing that in my surveys too. So we do not have the conditions being laid down to turn that confidence around. And so people will not spend. And that means that the GDP number will be lower. That means that consumers won't go out and spend, even if they have the money, and many won't have the money. And businesses won't invest because they can't invest, because they can't afford to invest. So again, it just shows you that the critical dimensions around this that needed to be thought about aren't being effectively managed, in my view.
Yes. So job ads are still down 21% from February level?
Yeah, so it's interesting how all the media have been reporting the increase in job ads. Just to put it in context, right? It's still 21% down from the February level, right? So jobs are there and some jobs are coming back, but not enough. And if you look at the quality of those jobs, a lot of them are part-time jobs. A lot of them are actually, in healthcare and those sorts of things, but they're not necessarily well-paid or structurally significant jobs in terms of future development for the economy, in terms of future growth. This is supporting the existing economy. This is actually very important work. I'm not saying that. But what I'm saying is that unless we have a focus on creating the next growth engine, we don't have a future, right? And that's the thing that I think the budget missed.
Yes, I completely agree, Martin. So SQM research says national residential property listings are decreased in September. We know there's a big difference between what's reported and what we see on Twitter and whatnot. So what are your thoughts on all this, Martin?
Oh, I just get so frustrated with all the spruikers talking about the property market's booming and everyone's coming back and prices are high. Look, just, ignore that. Just remember what we've said before about the connections between the media and the property portals. The truth is, I think SQM is close to the mark here. Their data is actually pretty reliable, I think. The listings numbers are down in a number of areas. It varies by different locations, but we're not yet seeing that sort of uptick. However, my forward-leading data suggests there are now people considering whether they should put their property on the market. Some people who've got the end of the mortgage interest and payment holidays coming to an end quite soon. Other people, property investors, saying, well, if I'm not going to see any capital growth, maybe I should get out. My own view is it's probably going to be after Christmas, after the holidays, that we're going to start seeing that come up again. But quite interesting dynamics here. And just wanted to highlight that there are significant changes, like in Hobart, market is way down from where it was.
Yeah, that is surprising because, as I've said, that we're seeing a lot of positives in the Tassie property market in terms of people wanting to get out of the states with stricter lockdowns down to Tassie. So whether or not we open our borders up, I think we're trying to next week with a couple of states. But yes. All right, so mortgage stress, this is ticked down a little bit, Martin. Any explanation why that is?
Yeah, so there's a few people got back to work, which of course helps, and a few more people whose second job wasn't there is now back with more part-time hours. So that's helped a little bit. Plus the fact that we've still got some further extensions, both the JobKeeper in Victoria and also to the mortgage repayment holidays. So that's helped a little bit. So but only marginal improvement, right? We're still at 39.5%. We were just over 40% last month. And if you look at the detail on the next slide, you can see that there's some quite significant variations across the states, with the higher levels of mortgage stress in Tasmania still. So we've still got this issue of compression between incomes and property prices in Tasmania. Victoria, came back just a little bit, a few more people working now relative to previously, as the lockdown in the state was, just eased back a little. And in the Northern Territories, rental stress is still very high, particularly in New South Wales. I'm talking here always on cash flow, money in, money out. So a lot of property renters are actually under the gun, particularly in New South Wales and Victoria, on average 35%. Property investors are still struggling as well with compressed rentals. So rental returns are continuing to drop, and that's creating huge issues. And of course, now some of those rental holidays are coming to an end, and suddenly people are realizing that wasn't actually a real holiday, it was a postponement of those rents. So what happens now? Some people are now moving from some property to cheaper property to try and deal with that. And the overall financial stress metrics, which we calculate, which is all of those things put together, shows that, interestingly, some of the highest stress, financial stresses in New South Wales, you might expect that, but it's also in the ACT at 42.8%. And I was a bit surprised about that when I started looking. Of course, the fact of the matter is that the economy in the ACT is quite narrowly based, and a lot of it's to do with, Parliament and those sorts of things. But the rest of the economy there is also very weak too. So this is not, for me, boding well for the next 12 to 18 months. Going back to my demand question, right? With this amount of stress in the system, more people are going to hunker down, more people are going to basically save more where they can, look to try and pay down debt where they can to be able to manage this, because they're not confident of a bounce back anytime soon. So I don't see any V-shaped recovery to mortgage stress anytime soon.
And the thing that I find interesting here, the places that are the most expensive, so, relatively high mortgage stress in New South Wales, but it's the rental stress, the people that can't afford a mortgage, and that's already 50%. So it's almost like these people are going to be forced to move, like out of the cities and out of the high cost, even rental locations. Similar in Victoria, 40% and 39% ish. And then completely different story in places like Tassie and SA, where there's not a lot of rental stress because it's fairly cheap to rent. But the mortgages, that figure really surprises me. 54% of people with mortgage stress in Tassie.
And that's partly to do in Tasmania with the heavy dependence on tourism, right?
Yeah.
And heavy dependence on the SME sector. So those are some of the reasons why. So it's pretty interesting.
The only other thing I'd say is in Tassie or everywhere, I guess, a lot of these sort of startups that are reliant on tourism, they use their house and their mortgage for their business purposes, don't they? Yeah.
They do, absolutely. Yes. And about 1/3 of SMEs basically have a mortgage, and that mortgage is on their primary property. And so I've always said the first domino to fall over here will be the SME related failures that will then fall over onto their mortgages. So unfortunately, that's what I think
That's what we
playing
see
out.
in the data.
Yeah.
So stress by different segments. You've got a few here, Martin.
Yeah, well, just to highlight that we've still got in mortgage stress, younger young families and first-time buyers very much exposed. Then the urban fringe, you'd perhaps expect that. But what's interesting with rental stress, you're seeing a lot of that with the first generation people coming to Australia, the multicultural establishment, and also some of the more mature families now in rental stress, and young affluents, in other words, people who have quite good incomes, but don't yet own a property. And financial stress and investor stress is, again, rather different, right? So a lot of the investor stress is more affluent households because they've got multiple properties, cross-leveraged, and their rental streams are being squeezed, and not many of them are necessarily getting the principal interest holidays from the bank, so they're being caught in a bit of a vice. And overall, as a result of that, financial stress is not something you're seeing just in one or two areas or one or two types of families. It's quite broad-based, and that's the point about the financial stress. There's quite a few that are actually now registering. So this is a broad-based structural issue that we're seeing in Australia.
Yeah, no, I love this granular data, and as you said, it paints this picture that affluence and professionals, established families, financial stress, investors that are stressed because of the way that so much of our economy these days is leveraged, and we're borrowing against our shares, our properties, these things that were at record levels. And so when then those assets turn, we see that reflected in these numbers. But these young families, 73% mortgage stress, that's their big asset. That's the majority of their wealth is tied up in this mortgage. They haven't got shares, portfolios, and rental properties as well. And it's hard for a young family to get behind, just like with the supers. If they sell their super and if they're mortgage stressed and they're back to square one and living off credit cards, and now they're 30 instead of 20 when they were starting, it's so hard to get back in front. And that's where it just a lot of smart people are saying that getting people to dip into their supers and that was one of the worst ideas we could have done.
It was a crazy idea. It should never have been done. But who can say? Well, one other point: if you overlay buy now, pay later, and payday loans and other credit over the top of this, right? There's a strong correlation between the stressed areas here and increases in other types of debt. So the total debt pool, although personal credit is a lot lower, it's actually being concentrated in those with all of these financial pressures.
It's the falling into like the shadow banking system, almost getting lost a little bit.
Absolutely. Yep.
All right. So you've got some suburbs here, Martin, on the map.
Yeah, this is just Sydney, just to make a point, right? In terms of, you can see that it's Western Sydney as you'd expect. There are some hotspots closer in, but places like Campbelltown and Blacktown and the hills. But the point I wanted to show here was some work I've been doing where I've been mapping JobKeeper and JobSeeker down to a postcode level, right? And the next slide is actually just an example again of Sydney of JobSeeker. And if you compare the two slides, what you start to realize is that there is a very high correlation between mortgage stress and a predominance of job seekers, right? So what we're seeing is an overlay of mortgage stress, job seeker, job keeper, and it's all consistent. So we're starting to see interesting correlations between all of those things. So that tells me something about the modeling, which is that the job keeper, job seeker, mortgage stress level is all very strongly connected. And indeed, it is connected in my models.
So, summary here, Martin, have you changed anything from last month?
Yep. So on this summary slide, the first thing I want to highlight is that my best case, which I've called out, included a COVID vaccination, right, has actually now turned positive, right? So there is still a path to positive house price growth over the next 2 or 3 years, right? Whereas previously it was negative, right? And that's significant because what it basically is recognizing all of these issues about tying back, loosening lending standards, in other words, getting more people to borrow more, taking rates low, all of those things. There is a path to that. I only give it a 25% probability in my scenarios. My main scenario is still for a longer term crunch with prices lower, and that's how I do most of my modeling. But I just wanted to call out that I have actually adjusted my scenarios based on all the data that's coming through and based on what I'm seeing in terms of prospects, right? But it's all to do with, can they turn their credit tap back on? Will people borrow? Which goes right back to my demand question. And at the moment, I don't see a huge amount of appetite on the demand side. So that's why it only gets 25% rating.
And in terms of COVID, I think we're starting to see a lot of data now that we'll find out that it's certain genetic predispositions, which is why it was so much worse in New York and Italy. And there's a reason why it's not hopefully as bad as we thought. So I don't think we necessarily have to get that vaccine. I know there's a lot of people that won't be very keen for that. But I think we need to change those conversations because we're getting these numbers down, and it's ridiculous that we're still in the stage 4 lockdown.
Yeah. So the critical question is the borders, right? Because Australia is so exposed because of international trade and because of students and because of tourism, right? If the borders remain shut in a year's time, then my better scenario just can't play out, right? And it's interesting that in the budget they had two scenarios, one of which basically assumed that there'd be a vaccine and things would open up, and the other didn't assume that would play out. And I think they're right to run those two scenarios. But I think we're getting to understand a lot more about the virus now. And as you say, naively just shutting everything down and then trying to open it again, I think it needs to be much more sophisticated, track and trace, all of those things. But we have to get the borders open at some point. Otherwise, the trade story, the student story, and the tourist story is going to be critically negative for us. I was talking about students. Students, of course, sign up for 2 or 3 years, right, or maybe 4 years. So we've already lost 1 or 2 years of students from overseas because of what's happened already. And with China, of course, turning the attention away from Australia in terms of students, we might well find that, in fact, in sort of whole education sector is going to be absolutely against it for probably 2 or 3 years.
And just a bit of housekeeping, guys. So we've decided to turn ads off on the channel because there's so many crypto scam ads that YouTube haven't been able to take down. So in return, all we ask is that you smash that like button and leave a comment, share this video with friends and family. And Martin's got some housekeeping. So next Tuesday night, I'll be doing a bit of live Q&A with Martin on the world of digital monies, not just Bitcoin. It's on obviously the stable coins, and central banks and everyone is talking about these. And I think it's a big disruptor for the legacy financial world.
This is going to be a really interesting conversation. I'm very grateful for you coming back on the channel at 8 p.m. Sydney time on Tuesday. And I want to take the conversation forward there about where does the alternative structure of money come from? How does digital actually answer some of the issues that we're facing? So we can take this conversation forward then. And I encourage people to come join the show and ask a question live. It'll be a fun session and about an hour and a half, give or take. And I look forward to seeing you on the channel on Tuesday.
Fantastic. Hope you guys have enjoyed that one. Thanks as always, and we'll see you again next month. So cheers.